Good morning, good morning, good morning. It is Tuesday, the 1st of October. It is the morning blast with myself and Mr. Brown. Oh, just realised I've still got the Beastie Boys playing in the background. I'll mute that because the old man will get angry with me. Here he comes now. Here he is.
Good morning, Ryan. Good morning, everyone.
Good morning. Let me just read the legals.
To cut myself off today.
Yeah, try not to. Discussed on this. No, sorry, I'll start again. Nothing discussed on this basis session constitutes trade or investment advice or infers any kind of endorsement by PIQ Global Limited, Traders PIQ or PIQ Suite, or its affiliates, including the hosts, Mr. Michael Brown and myself, Mr. Ryan Basie. How are you? Have you had a coffee yet? Because yesterday you were rather fucking grumpy.
Yes, I have had a coffee. I'm feeling marginally more chipper this morning. You'll be pleased.
Perfect. That is music to my ears.
How many coffees have you had, I guess, is the bigger
To be
question.
honest, I'm currently halfway through what will be my third single shot of espresso. So I believe
3 too many, I would say.
I believe the technical term is tripping balls.
Oh, God. Oh, no.
Oh, no. Oh, no. Go on. What's happened? What's happened overnight?
Right. Yes, indeed. Good morning, everybody.
Yesterday.
Well, it was a relatively positive start to the week for risk assets yesterday. The S&P 500 ending the day around 0.4% higher. The NASDAQ up by around about 0.25%. Interestingly, the market was flat for pretty much the entire day. And then we saw most of those gains coming through right in the last sort of 15 minutes of the cash session, which just implies that there was probably quite a lot of month and quarter end buying going on. In fact, the market imbalance was 5 billion to the buy side, which pretty much explains away all of those gains we did see, and also perhaps helps to explain why we see those gains evaporating just a little bit in early trade this morning. In terms of markets elsewhere, it was a quiet day on the most part, although we did have a little brief bout of volatility coming in after some remarks from Fed Chair Powell yesterday evening. Now, in truth, Powell didn't really say much new. His prepared remarks, at least, were pretty much a mirror image of what he said at the September FOMC press conference, in that policy will move to a more neutral stance over time, and that policy is not on any sort of preset course, and that decisions will continue to be made on a meeting-by-meeting basis. What seemed to excite market participants was a remark that Powell made during the Q&A section of his appearance, which is where, and I quote from the headlines here, he said, "The speed at which the Fed cut will depend on the data, and that I don't feel like this is a committee that is in a hurry to cut quickly." Now, some would perhaps point to that pouring a little bit of cold water on market pricing. Personally, I don't think that's really anything that we didn't know already. I mean, if you look at
isn't that just like basically all he's saying is a different way of saying, yeah, we're data dependent and we're not planning on getting carried away?
Oh yeah, absolutely. And also, if you look at the dot plot, the dots say that the committee aren't in a hurry, because you had the 50 basis point cut in September, and then you've got a total of 50 basis points left in the dots for the remainder of this year, which implies 25 in November and another 25 in December. So yeah, I'm not sure that Powell is really saying anything new with that one. But I guess in a day that was relatively quiet and lacking in other catalysts, it was enough to jolt the market into life a little bit. We had some selling across the Treasury curve, with the 2-year yield rising by around 9 basis points on the day to 3.65%, and the dollar also traded notably firmer after those remarks as well, with the dollar index adding around 0.5%, trading up to a high of around 100.90, which is where we reside this morning. What's also quite amusing, perhaps, about what Powell was saying yesterday was that about 2 hours before he spoke, we heard from next year's voter, Goolsbee, the Chicago Fed president, and he said that rates must come down a lot over the next 12 months, which is slightly at odds with Powell saying that no one on the FOMC is in a hurry to deliver rate cuts. but there we go. In terms of other bits and bobs from yesterday, gold was lower yesterday, a second straight daily decline for the yellow metal, down around about 1% on the day, and actually the worst day for gold in just under 6 weeks. And in the Eurozone, a couple of things worth noting. We had the flash inflation figures out of Germany yesterday, a little bit cooler than expected, in line with the Spanish and the French data that we've already had. CPI rising by 1.6% on an annual basis in September, down from the 1.9% that we saw in August. And we also heard from ECB President Lagarde yesterday, who just kind of really cemented the idea that they are going to deliver another cut at the October meeting. Lagarde was saying that the Governing Council latest developments have strengthened their confidence that inflation will return to target in a timely manner, and that the Governing Council will take that increased confidence into account in October. And that, if it wasn't enough on its own to cement the chances of a cut, Viraj Patel flagged yesterday on Twitter that that is almost the exact same language that Fed Chair Powell used at Jackson Hole before they then delivered a cut at the September meeting about 4 weeks later. So a little bit of a parallel there.
Just to flag, Viraj is one of the must follows in my book.
Oh yes, absolutely.
Incredibly good, and also great little infographics, which he won't tell you himself, but I had a little hand in helping him out with some of those many moons ago.
Christ, he must have been desperate.
Well, yeah, well, this is it. I'll let your words, not mine, but I will take that.
That's pretty much it from yesterday. The only other thing, just of note, was in terms of China. Obviously, we've had this big risk-on rally in China, and
have we? No one's mentioned it.
Apparently so, and we've also. Obviously, off the back of the stimulus, Chinese stock turnover hit a record $340 billion yesterday. It is worth noting, of course, that China is now on holiday for a week. It is Golden Week in China. So perhaps people buying ahead of that holiday did fuel a bit more of that turnover than you would otherwise expect.
I think also there is an absolute, the technical term coming up, shit ton of FOMO trading that's going on, which normally ends in tears. As myself, Michael have said before, we're not saying go short this, but we're definitely saying that going long is a very risky trade because one, it's China, and two, it's China. So if you're on a third reason, it's China. When there's a lot of weak length in the market, it doesn't take much for that weak length to be flushed out. And when that happens, there is normally a lot of blood on the floor. So if you are involved, be careful. But good on you. Everyone loves a trier. Right. Let me read some headlines out from our friends at News Corp. Obviously, we're going to start in the Middle East because why not? So we've had the Yemen's Houthis have said they will escalate military operations in response to Israeli attacks. Obviously, we had yesterday we were reporting that there's been some Israeli attacks on Yemeni ports and infrastructure. We've also had overnight the military base hosting US forces near Iraq's Baghdad airport was targeted by a rocket attack. If memory serves me correct, we had this maybe 4 weeks ago as well, and that was timed just as an Iranian official was going into Baghdad. I'm not sure if one's going there now, but just a bit of background color for you. We've also had the Pentagon said that the US is to send a few thousand additional troops to the Middle East to boost security and defend Israel if needed. Few headlines now from PIQ/Reuters. Obviously, check out the suite. We've currently undergoing a bit of a release this morning, which has been quite fun. Basically, just cards on the table because why not? We've had a couple of issues with layouts kind of randomly going back to the default layout that we present rather than the save layout. We think we've solved that, which would be great. So hopefully that's one that everyone can stop moaning at me about. But anyway. The Israeli military says intense fighting with Hezbollah is currently taking place in South Lebanon. What was I about to read there? Oh, yeah, there you go. China's and the US are set to hold talks on economic and trade issues. They will be exchanging views on bilateral economic and trade relations and key issues of mutual concerns, including restrictions on electronic vehicles. So one to keep an eye on there. One interesting thing someone raised yesterday, which I kind of almost forgot, was Biden. Obviously, we're coming to the end of his term now. Biden basically rolled back most of Trump's trade policies, except one, which was the China tariffs. Now, if Trump does get in, yeah, and it's a very tight race, 50-50. I've got no view because I'll point and laugh at whoever is in. I'm indiscriminate. But it'll be very interesting to see if Trump does come back in. He gets very anti-China again, because if you remember, we had how long did we go? How long did we go for that? Like 90% done on trade talks. We were like 90% done for like 2 years. So yeah, I for one would welcome a return of 90% done language, because that was just a barrel of laughs when that happened, he said sarcastically. But anyway, I digress. We've also had reports this morning that a vessel has been hit by a sea drone off Yemen's coast. Obviously, a sea drone being like a remote controlled boat, basically. The vessel was hit by an uncrewed surface vessel, 64 miles northwest of Yemen's Hudaydah on Tuesday. The vessel reported seeing 4 splashes close by, and all crew are safe, and it was proceeding to its next port of call. Obviously, as well, the big news in the US is this port strike has gone ahead as expected. And lo and behold, I've woken up and everyone on X is an expert in ports and US infrastructure and striking action and Teamsters. Who saw this coming? Apart from everyone that listens to the Morning Blast, where me and Michael have been calling it for about a month now that this exact thing would happen. There's a few people that I would only be listening to. I will make a list on there on Twitter later on. I have put some posts up in the Jumbotron or whatever you want to call it. Sal is one of the key follows, I would say, and so is John. So definitely follow those. Ignore the tourists. Quite an interesting comment I saw this morning, which is very interesting, was from the Teamsters Union. I quote, this is their official kind of press release, and this is word for word. The US government should stay the fuck out of this fight and allow union workers to withhold their labour for wages and benefits they have earned, which I'm all for a bit of punchy language in an official document. I've also put up on the Jumbotron quite an interesting map showing that a surprising number of inland ports, and we are talking ports all the way up through the Midwest, rely on access to the open ocean via these ports that are now choked off. Again, I'm no expert in pretty much anything, but given that we're the tail end of harvest and a lot of crops are exported, I'd imagine, and it seems to be the case, that this could lock in some crops within the Midwest, which is not a great situation for them. And finally, from my end, we've got the French Premier Barnier is eyeing a lot of tax hikes worth up to 8 billion euros, and we'll be hearing from him later today. So it could get fiery, and if the French don't like it, they tend to strike. So that's one to watch. And who doesn't like a striking Frenchman? They're pretty good at it, to be fair. But anyway, that's enough from me. Back to you, Mr. Brown.
Well, they are. I'm going to go long Goodyear and Bridgestone and God knows whoever
Oh
else that
yes, I
makes
like it.
tyres,
Yeah.
because they do like
Oh,
burning those.
yeah. I'm looking forward to posting some videos of like some farmer with his like muck spreader in front of a council office or something like that. It always seems to be the way. Every
It
time we get a
does.
muck spreader.
And if anyone knows who makes those fetching yellow high-vis jackets and they're
Oh
listed, then
yes,
give me a
mine.
shout.
I've got a
Right.
jumper. I've got a jumper, but I did. Oh, bless. I did have a jumper
Oh,
like that. Big
oh
yellow.
dear. Oh, R.I.P.
Anyway, go on.
Right, moving on to today. Quite a busy data docket, actually, and a fair few things of interest on there. Kicking things off this morning, we get final manufacturing PMIs from the Eurozone and from the UK. They are both expected unrevised from the flash estimate, so that would be 44.8 in the Eurozone and 51.5 here in the UK. At 10 this morning, we have the September Eurozone flash CPI data. And of course, this, well, if an October ECB cut isn't already nailed on, it certainly will be after the inflation data that we get this morning. Headline CPI is expected to have risen by 1.8% on an annual basis, down from the 2.2% prior. And that will be the lowest annual rate of inflation since April of 2021, and also be considerably below the ECB's 2% target. Core inflation, meanwhile, that's expected to have risen by 2.7%, down from the 2.8% prior, and would be the lowest since April of this year. The Euro OIS curve seeing around about a 90% chance of a 25 basis point cut in October at this moment in time. 53 basis points worth of cuts are priced in by the end of the year. So it is pretty much a done deal already, and I think therefore the scope for a further significant dovish repricing is relatively limited on the back of that data that we get in an hour and 15 minutes time. Moving into the US session, we have both at 3 o'clock this afternoon the JOLTS job openings data. Job openings expected at 7.66 million in August, down from the 7.67 million prior, and that would be the lowest level of job openings since January of 2021. Also at 3, we get the latest ISM manufacturing PMI data. That's expected to imply a modestly slower pace of contraction in September, with the index of 47.5 from a prior 47.2. Of course, it's also worth paying attention to the employment sub-index ahead of the non-farm payrolls print that we have out on Friday lunchtime. A busy docket of central bank speakers also lies ahead. We hear from the Fed's Bostic, Cook, Barkin and Collins as the day
Oh, brilliant.
progresses. 4 ECB speakers in the mix as well, in addition to the new SNB Governor Schlegel and the BOE Chief Economist Hugh Pill. We will see whether the market struggles to swallow his message.
Don't.
And
Oh, bloody hell.
sorry, mate. Sorry.
Oh, God, you couldn't let it go, could you?
And last but by no means least, in terms of earnings, of course, Q3 earnings season kicks off next Friday with the banks, including JP Morgan, reporting. But we do hear after the market close from Nike. So, well, just do it, I suppose.
Oh, God. Oh, make it stop. Make it stop. Did you have please tell me you didn't have that wrote down.
No.
Oh, thank God for that. Or else you'd be at the door. Just something that's just landed whilst we've been talking and us listening to your horrendous puns. The new Japanese PM is appointed a Abenomics proponent as finance minister. The appointment of Kato, 68. This is his age, by the way, not his preferences, who served as health minister and other key positions under Abe administration to back his expansionary fiscal and monetary policies. So that's one to watch. Maybe we go back to that. It'd be nice, wouldn't it? Anyway,
Good.
any more?
No, that is all from me.
No more puns you want to get out there?
No. I'm all punned out today.
Okay, that's good. We everyone is grateful for that. Some interesting news. Well, actually, first off, a little plug for PIQ. Obviously, our promotion for a year's free access expires this week. So if you want to get a hold of that, use the coupon code BLAST at the desktop version checkout. We not only is that going to be reverted to a 6-month promo code at some point, but it's also prices will be going up. So if you get in now, not only are you getting a year's free, but when you do finally start paying, which we're certain you will, you'll be paying £10 a month rather than £30 a month, which is going up to. And you know what? In a year's time, it might even be more expensive than that. Who knows? Who knows what I'm going to start charging? I need to eat, man. I need some gar money. But anyway, guys, thank you for listening. I'm going to start going on. I'm going to go back for my 4th coffee of the day. Michael, as always, thank you very much for speaking. And we will see you tomorrow. If you are trading, keep it tight. And now for the awkward silence so we don't cut each other off at the end of the show.
Indeed.
See you, mate.
Thank you, guys.
Thank you, mate. Cheers, buddy. Bye. Oh, sorry, I forgot to say we're doing that. What's the? We're doing the show with Forex Live, with Forex Flow Live, aren't we? Today?
With
Forex
Ryan.
Analytics.
Yes, that's right.
Yeah.
Yeah.
It's a little plug for that. Sorry, I'd be very rude if I didn't plug that. Anyway,
10:30.
right.
We'll post the link out.
I'll post the link out. Well done. At least Dad's involved. Yeah, thanks, Dad. Right, see you later. Bye, mate.
Bye-bye.
5, 4.